Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. Today I would like to discuss with you about few case studies on capital budgeting and cost of capital. So after going through this topic, the learner will be able to understand and apply the capital budgeting techniques in real life scenarios and also analyze the cost of capital in various real life situations. Case study 1, Significance of capital in business operations. The scenario is ABC Manufacturing Company has been in operation for 5 years. The company's growth has been steady, but the management is now considering expanding its operations. They have realized that an increased amount of capital will be necessary to sustain this growth. However, they are unsure of the importance of capital in this expansion and how it will affect the overall operations. The tasks to be performed in this case are: why is capital important for ABC Manufacturing Company's expansion? How does capital impact the daily operations of a business? What could happen if the company underestimates its capital needs? So let us understand the significance of capital. Capital is essential for ABC Manufacturing Company's expansion as it provides the financial resources required to purchase new machinery, hire additional staff, and cover the cost of entering new markets. So, without sufficient capital, the company would struggle to meet these financial demands, potentially stalling growth. Coming to impact on daily operations. So, as we know, capital affects a company's ability to maintain inventory, manage day to day expenses, and invest in technology. Adequate capital ensures smooth operations and ability to meet unexpected expenses or downturns in business. Consequences of underestimating capital needs. If the company underestimates its capital requirements, it may face liquidity issues leading to operational inefficiencies, delayed expansion plans, and possible loss of market share. It could also result in increased borrowing costs or forced liquidation of assets. Second case study, types of capital and their uses. The scenario is XYZ technology startup is in its initial stages and needs to raise capital to develop its product, hire a team, and start marketing efforts. The founders are debating whether to focus on raising equity capital or debt capital. So, based on this particular scenario, we need to find out solutions to the questions: what are the different types of capital that XYZ tech startup could raise? What are the advantages and disadvantages of equity capital versus debt capital? And which type of capital would you recommend for XYZ tech startup and why? So let us see the types of capital that are available to XYZ tech startup. XYZ tech startup can raise equity capital where ownership stakes are sold to investors, or debt capital where the company borrows money that must be repaid with interest. Additionally, they can explore hybrid capital options like convertible debentures. Coming to the advantages and disadvantages, equity capital have advantages like no repayment obligation, access to investor, because here the management or shareholder, the proprietor of the company, they used to invest their own property or funds. So as a result, there is no repayment obligation. Expertise will be there and no impact on cash flow. But coming to the disadvantages, dilution of ownership, potential loss of control, and sharing of profits. So, in case of debt capital, the advantages are retention of ownership, tax deductibility of interest, and clear repayment terms. It has some disadvantages like repayment obligation, impact on cash flow, and possible credit rating impact. So, for a startup like XYZ Tech, equity capital is generally preferable because it does not impose immediate financial pressure and allows the company to grow without burden of debt repayments. So, however, a mix of both could be considered depending on the availability of investors and the startup risk tolerance. So, this recommendation I would like to recommend to XYZ Tech Equity Capital. Then, case study 3 is estimation of fixed and working capital requirements scenario. LMN Retail is planning to open a new store in different city. The company needs to estimate the required fixed and working capital for this new store. They are unsure how to estimate these amounts and what factors to consider. The questions raised in front of LMN Retail is how should LMN Retail estimate its fixed capital requirements for the new store? What factors should be considered when estimating working capital needs? How can LMN Retail ensure that it has sufficient working capital? So, first, go with estimation of fixed capital. LMN Retail should consider the cost of purchasing or leasing the new store, renovations, furniture, fixtures, equipment, and initial inventory. They should also include any long term investments needed for the store's operations, such as technology systems. Then, factors for estimating working capital, that is, the average inventory levels required to meet customer demand, the average receivables period and terms offered to customers, the credit terms agreed upon with customers, seasonal fluctuations in sales and cash flows, buffer for unexpected expenses. Then ensuring sufficient working capital, LMN Retail can ensure sufficient working capital by accurately forecasting sales, optimizing inventory levels, negotiating favorable payment terms with suppliers, and maintaining a credit line for emergency needs. Regularly monitoring cash flow and adjusting forecast based on actual performance will also help in maintaining adequate working capital. Next case study, methods and sources of raising capital. The scenario is PQR Corporation, a mid-sized enterprise, is considering several projects for expansion but needs to raise additional capital to finance them. The company is exploring different methods and sources of raising capital. What are the various methods PQR Corporation can use to raise capital? What are the key sources of capital for mid-sized enterprises? Which method and source of capital would you recommend for PQR Corporation and why? So these questions are in front of the management. Then methods of raising capital. PQR company may raise capital by issuing equity, means in the form of shares or stocks, issuing debt, either it may be in the form of bonds or loans, retained earnings, leasing or asset based financing, and also they can go with crowdfunding or venture capital for a specific projects. Coming to the sources of capital, PQR company has different sources like banks and financial institutions for loans or lines of credit, public markets for equity or debt issuance, private equity or venture capital firms, internal funds from retained earnings, government grants or subsidies for specific industries. So these may be the sources of capital for PQR company. So recommendation for PQR corporation, a combination of methods might be suitable depending on the project's risk and return profile. If The projects are high risk with high potential returns. Equity financing might be preferable to avoid the burden of debt. For less risky projects with predictable cash flows, debt financing could be more appropriate due to the tax benefits and retention of ownership. Additionally, exploring government grants or incentives might reduce the capital requirement. The next case study, new product launched by ABC Electronics. Scenario: ABC Electronics is considering launching a new line of smart home devices. The project requires an initial investment of $2 million. The expected annual cash inflows are $6 lakhs for the next 5 years. The company's cost of capital is 10%. What is the net present value of the project? What is the internal rate of return for the project? Should the company proceed with the project based on NPV and IRR? What would be the payback period for the investment? So, before going to invest in any of the investment proposal, the company they would like to see its profitability, whether it is benefited to the company or not. So, for that, they used to apply different types of capital budgeting techniques like NPV, IRR, and payback period. So let us start with NPV calculations. NPV is net present value method. So with the help of this NPV method, we can find out the time value of money by discounting the cash flows with the discounting factors. So if NPV is positive, one should acquire the project. If not, if it is negative, then they should not go with the proposal. So based on this particular data, we have calculated NPV, that is 1,89,541.52 dollars. So it is a positive NPV. If NPV is positive or greater than zero, accept the project. Accept the project. Then second one, using IRR. IRR is the rate that makes NPV equal to zero. So using the financial calculators or Excel, the IRR for this project is approximately 14.5%. So this we can compute by using trial and error method and method of interpolation. By using the formula, IRR is equal to lower rate of return plus NPV at lowest rate of return divided by NPV at lowest rate of return minus NPV at highest rate of return into highest rate of return minus lowest rate of return. So using this formula, we found out 14.5% is IRR. Then let us see the decision based on NPV and IRR. Since the NPV is positive and the IRR is 14.5%, this 14.5% is greater than the cost of capital, that is 10%, which is given in the scenario itself. So ABC Electronics should proceed with the project. And coming to payback period calculation, the payback period is the time it takes to recover the initial investment. So payback period is equal to initial investment divided by annual cash inflows, because here we have even cash flows. So every year throughout the lifespan of the project, we used to generate the same type of cash flows, that is 6 lakhs dollars. So as a result, we used to apply payback period is equal to initial investment divided by annual cash flows. So then if you simplify this, we identified that payback period is 3.33 years. It means that the company can recover its initial investment of $2 million within 3.33 years. Then next case study, replacement of machinery at XYZ manufacturing. So the scenario is XYZ manufacturing is considering replacing an old machine with a new one. The old machine has a book value of $50,000 and can be sold for $20,000. The new machine cost 20,000 or cost $2 lakhs and is expected to reduce annual operating cost by $60,000 for the next 6 years. The company's cost of capital is 8%, and we have given tax rate is 30%, and the new machine will be depreciated on a straight line basis over 6 years. So the task to be performed under this case study is: what is the initial investment outlay for the new machine? What is the annual depreciation expense for the new machine? What is the net present value of the investment? And should XYZ manufacturing proceed with the replacement? So let us go with initial investment outlay. The initial investment includes the cost of new machine minus after tax tax and salvage value of the old machine. So initial outlay is 2 million minus the cost of new machine is $20,000 and the tax rate is 1 minus 0.30. Then if you simplify, you'll get $1,86,000. That is the initial investment. And coming to annual depreciation expense. So depreciation expense is equal to cost of the new machine divided by 6. Then we'll get $33,333.33 per year. Then NPV calculation, first calculate the after tax savings and then discount them to their present value. So annual savings after tax, that is $60,000 multiplied with tax rate 1 minus 0.30. Then annual savings after tax we got $42,000. Then again using this NPV formula we found out NPV value $30,354.40. Again it is positive. So the decision based on NPV, since the NPV is positive, XYZ manufacturing should proceed with replacing the old machine. So that is the best option to the XYZ company. Then next case study is international expansion by Global Retail Incorporation. The scenario is Global Retail Incorporation is considering expanding into a new international market. The project requires an initial investment of $5 million. The expected cash inflows are $1 million per year for 7 years. The company's discount rate for international project is 12%. So using this data now we have to calculate what is the net present value of the project, what is the internal rate of return for this project, what risks should be considered in this international expansion, and should Global Retail Incorporation go ahead with the expansion based on the NPV and IRR. So using this scenario, first of all we should calculate NPV. Then the NPV value we got a positive negative value. So as NPV is negative, it indicates that a loss, so the company should not go with this particular proposal. Then whereas coming to IRR calculations, the internal rate of return for this project calculated using the financial tools is approximately 8.5%. Then coming to the risk considerations, the risk include exchange rate fluctuations, political instability, regulatory challenges, and potential differences in consumer behavior. So, as you want to enter into an international market, first of all, there should be a lot of fluctuations in exchange rate that also influence the company's profitability, and political instability that also have some kind of adverse impact on business performance, and regulatory challenges and potential differences in consumer behavior. So all these kind of risks may have with Global Retail Incorporation. The next decision based on NPV and IRR. See, since NPV is negative and IRR is 8.5, which is lower than the discount rate or cost of capital that is given 12%. So as a result, Global Retail Incorporation should reconsider or potentially reject the expansion. It is not advisable for Global Retail Incorporation based on NPV and IRR methods. The next case study is investment in renewable energy by Green Energy Corp. The scenario is Green Energy Corporation is considering investing in a wind farm project that requires an initial investment of $10 million. The project is expected to generate cash inflows of $2 million annually for 8 years. The company's required rate of return is 10%. So, based on this scenario, we need to calculate the NPV or net present value of the project, determine internal rate of return, what would be the impact on the decision if the cash inflows were uncertain, should the project be accepted based on NPV and IRR. So using this data, first we used to calculate NPV value. So we got NPV positive, and based on the IRR calculations using some trial and error method, we have computed approximate value of IRR, that is 14.5%. Then what kind of impact will be there on because of uncertain cash inflows? If the cash inflows are uncertain, then it is always better, we should go with sensitivity analysis or scenario analysis. Why? Because it should be conducted to assess how changes in cash flows would affect the NPV and IRR. Then next, decision based on NPV and IRR with a positive NPV and a greater IRR, the required rate of return. Green Energy Corporation should accept the project. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.